When we think about taxes, it usually boils down to two things, right? The chunk of money that comes out of our paycheck and that little extra we pay for stuff we buy, like a slice of pizza. But what happens when an entire country, we're talking 1.4 billion people, starts to change how it relies on one versus the other? Well, that's exactly what's happening in India right now, and it's a story that goes way beyond just the numbers. It's about the future of its entire economy. So the paycheck or the pizza slice. It sounds almost too simple, doesn't it? But which one a government decides to tax more tells you a fascinating story. It reveals its entire economic strategy, its definition of what's fair, and its vision for the future. And in India, the balance between these two is going through a massive seismic shift. Let's break down what that really means. All right, so to really understand this shift, we first need to get clear on the two fundamental engines that power any government's revenue: direct taxes and indirect taxes. The difference between them is the absolute key to unlocking the incredible story we're about to see in the data. Okay, a direct tax is pretty much exactly what it sounds like. It's straightforward. It's a tax that's levied directly on your income or on a company's profits. This is the tax on your paycheck, that's your income tax, or the tax that big corporations pay on their earnings, which we call corporate tax. The bottom line is, you know you're paying it, and you're the one paying it directly. Now let's talk about the tax on your pizza. Indirect taxes are different. They're levied on goods and services, and businesses basically collect them from you by baking them into the final price tag. The biggest example in India, of course, is GST, but it also includes things like customs duties on stuff that's imported. So it's a tax you pay all the time, but you don't always see it as a separate line item. It's kind of hidden. So let's put this all side by side for a second. Direct taxes, they're based on your income and profits. Indirect taxes, they're based on goods and services. The big difference is that with direct taxes, the person who's supposed to pay pays. With indirect taxes, that burden can be shifted to you, the consumer. And this leads to the most important point. Direct taxes are generally progressive, while indirect taxes are often regressive. And those two words, progressive and regressive, they aren't just fancy jargon. They get right to the heart of the whole debate about fairness. And that brings us to a really crucial idea about the whole philosophy of taxation. The mix of direct and indirect taxes a country chooses isn't just about collecting money. It's a statement about how fairly it believes that money should be collected from everyone in society. A progressive tax is all about your ability to pay. Think about income tax slabs. It's a perfect example. People in higher income brackets pay a larger percentage of their income in taxes. It's a core feature of direct taxes. Pretty simple, right? The more you make, the bigger the chunk you contribute. A regressive tax, on the other hand, is a completely different story. It takes a much bigger bite out of the wallets of lower income folks. I mean, think about it. A 10 rupee tax on a loaf of bread is the same amount for a CEO and a daily wage worker. But for that worker, those 10 rupees are a much, much larger fraction of their income. And that's the effect of a lot of indirect taxes. And this idea really reinforces the bigger role that direct taxes play. As an analysis in the Times of India put it, they are a key instrument for creating social equity. So you see, a country's tax mix isn't just a spreadsheet. It's a statement about its economic priorities and its values. So with all that theory in mind, let's get to the exciting part. Let's follow the money. The data from just the last 5 years in India tells this powerful story of a system in major transition, and honestly, the charts just bring it to life. Wow, look at this graph. Starting from the financial year ending in 2021, direct tax collections have absolutely skyrocketed. That line is so steep, we're talking a near threefold increase projected by 2026. This isn't just steady growth, this is an explosion. Now, let's compare that to indirect taxes. Collections have also gone up, which is a good sign. It means the economy is growing and people are spending. But look at that curve. It's a much gentler slope, right? It's a steady, gradual climb, not that rocket launch we just saw with direct taxes. But when you see them side by side, the story becomes absolutely crystal clear. That steep mountain of direct taxes on the left is climbing so much faster than the one on the right. This single visual tells you everything you need to know about the changing dynamics of India's revenue. Direct tax growth is just playing in a completely different league right now. And this huge difference in speed led to a truly historic moment, a real tipping point in India's fiscal strategy that the numbers show us with perfect clarity. Okay, let's walk through this. In the financial year 2021, you can see indirect taxes, the pizza tax, were actually higher than direct taxes. But then look what happens the very next year. Boom! A huge jump in direct taxes to over 14 lakh crore rupees, overtaking indirect taxes completely. And ever since then, that gap has just kept getting wider and wider. Let's just pause on that for a moment, because that's huge. Within the span of just 1 year, the government's entire revenue model basically flipped on its head. India went from relying more on taxes from consumption to relying more on taxes from income and profits. This right here is the great tax shift we've been talking about. And this trend, it's set to continue big time. The budget estimate for direct taxes in the 2026 financial year is a massive 25.20 lakh crore. That number right there cements the new reality. Direct taxes are now firmly in the driver's seat of India's public finances. So, okay, we've gone past the numbers. What does this trend really mean for the country? Why is this shift from our pizza to our paycheck so significant? Let's zoom out and look at the big picture takeaways. So, what does this all mean? Well, first, it points to a more equitable, a fairer tax system, one that leans more on those who have a greater ability to pay. Second, and this is huge, it's a massive sign of a formalizing economy. A surge like this doesn't just happen by accident. It's being driven by things like increased digital payments and all the data trails from GST, which are bringing more economic activity out of the shadows and improving tax compliance overall. Third, it marks a strategic choice to rely more on the country's growing incomes, not just its spending. And finally, it shows a sustained government focus on making tax collection itself just plain more efficient. You see, this shift isn't just some boring accounting change. It's a sign of a maturing economy, one that's moving toward a more stable and more equitable way to fund itself. So the really big question now is, how will this new balance between taxing our paychecks versus our pizzas fuel India's next chapter of growth?